wealthbranch.com.
8 ways to build investor confidence and not panic. Studies have shown we're more motivated by negative emotions than positive ones. We have a negativity bias. So as an investor, controlling our emotions is paramount. But how do we do that? Here are several ways to take charge of your emotions and improve your confidence as an investor. 1. Having a long-term investment horizon. The world is full of foolish gamblers, and they will not do as well as the patient investor. Charlie Munger. The temptation and action of short-term trades can be very appealing, and like Powerball, some short-term traders strike it rich. But in our view, short-term trading is more complicated than long-term investing, because when you make a short-term investment, you're saying to the market that you know the correct timing, price, and direction of the market. Professional traders must also invest a lot of time and attention into watching the markets. With long-term investing, you don't necessarily have to figure out timing. The goal is to figure out what companies have excellent long-term prospects and what price makes a company undervalued. Then you buy the stock and wait. The company does the heavy lifting by growing its earnings over time to make you very rich. In an interview with Charlie Munger and Li Lu by Chinese media company Weekly in Stocks, Charlie Munger highlights the difference between short-term gamblers and long-term investors.
A lot of people think there is such a thing as truth in the markets, that the market is going to tell you something just by bouncing around. That is not the way Berkshire Hathaway or Charlie Munger invests money. We have a view as to what the intrinsic value is of what is being traded, and we only buy it when we think it's worth more than we're paying. So we're trying to make a long-term investment by waiting for something to be underpriced and then buying it. And we don't give a damn about all these gamblers in the market. To me, they're just so much froth. And it's a foolish way to spend your time if you want to get rich. The Chinese who've gotten rich in Hong Kong over the last 50 years are not the short-term traders and the gamblers. It has been the long-term investors who sought out good long-term investments and stubbornly held them for long periods of time. And just as that worked for the Chinese in Hong Kong, it'll work for the Chinese on the mainland. It's not the short-term gambling that's good. It's the identifying the good long-term investment and sticking with it for a long time. My Berkshire Hathaway stock cost me $16 a share, and it's now selling for almost $300,000 a share. That's been a very good investment. It took a long time, and it was a long-term investment where I liked the people I was investing with, and I liked the companies I was investing in, and I just sat there for more than 50 years, and lo and behold, it's worked out very well. And there are lots of stories like that. It's natural for stocks to eventually go to value. But Ben Graham says in the short term, it's a gambling machine, the stock market. But in the long term, it's a weighing machine. In the long term, the market will figure out what's really worth it. Well, the beauty of it is that it keeps working when you're not. A great company will eventually earn more and more and more while you're just sitting doing nothing. And a mediocre company won't do that. So you're harnessing a long-range force that will help you. It's just very important. These mediocre companies they by and large are going to cause a lot of agony and very modest profits. If you do find it goes up a little, you have to sell it, you have to find another. It's a lot of work. Whereas you just buy one great company, if you get it the right thing at the right price, you just sit there.
Warren Buffett wrote in his 1996 letter to shareholders, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." In summary, the key is to pick a great company and hold it for a very long time. You'll also want to check the business story after earnings reports. Remember, we're trying to determine whether the company's earnings will be higher in 10 years or 40 quarterly earnings reports from now. Your entry point may be a fair price, but your exit point may not be for 10 years or longer. Therefore, companies you own should be ones you are willing to hold for 10 years or more. 2. Due diligence. Risk comes from not knowing what you're doing. Warren Buffett. Due diligence builds confidence. Confidence comes from researching companies, management, and industries. If you understand what's going on in a specific industry or company, you'll have the fortitude to buy or hold more shares when prices go down. 3. Diversification and inverse correlations. We'll go deeper into advanced diversification strategies like Ray Dalio's famous all-weather portfolio, but in short, you may want to include inverse or negative correlations in your portfolio. Famed investor Ray Dalio explains.
The real question for me was, what were the marginal benefits of diversification like? What is that going to look like? Okay. And what I then decided to do was to think about risk and the number of sample size and the correlation of the bets, broke it down to each of its components, right? So, to use an example, let's assume you have, to make it simple, a return, something that has a 10% risk. We'll call risk standard deviation. And let's make it simple, and let's say it had a 10% return. And let's say I add in another asset, another return asset, return stream. I add in a second, a third, a fourth, a fifth, up to whatever number. How would that reduce my risk if it on average has a 60% correlation? Or if it has on average has a 40% correlation or a 0% correlation? How would that change? Wanted to know that, right? So that's what this chart shows, right? And so, so imagine you have a 10% average return. You don't know which bet is going to be better. Has a 10% average return and a 10% risk. And you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe is about 15%. And you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows, okay? And it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic is you only need to do this simple thing. The simple thing is to find 15 or 20 good uncorrelated return streams. Things that are probably going to make money, but you don't know, but they have a good probability of making money, and that are uncorrelated, that have low correlation. That told me that's what I have to go after, right? That's the key. A lot of people think that the most important thing you could do is find the best investments. Okay? That's important, okay? But there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5, right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably, nobody's humanly capable in an efficient market probably to pick investments that are 5 times as good individually, but so that path. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. You know, like if I can get 0 correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%, okay, as distinct from 40% with any one of us. So that's the power of portfolio construction and the power of diversification, okay? So it tells me what I have to go after.
4. Correctly sized investments. If you're a novice investor, or if you're slightly unsure of a company, you may want to allocate only 3 to 5% of your capital per company. For example, if you have $100,000 cash and you invest 3%, or approximately $3,000, into a declining dividend company, the max you can lose is $3,000. You don't want to invest in a company that would go bankrupt, but in the event it does, you can write off up to $3,000 of the excess stock losses per year. It's a lot easier to hold a company for the long term when you invest only 3% of your capital versus 30% in a single company. Once you get more experience or capital, you may be more comfortable concentrating your investments in fewer companies like Charlie Munger. 5. Dividend. Author of the Dow Theory Letters, Richard Russell writes, "A stock dividend is something tangible. It's not an earnings projection, it's something solid in hand. A stock dividend is a true return on investment. Everything else is hope and speculation. An excellent dividend stock can give you the confidence to hold for a long time." Before I understood investing well, I owned a REIT stock I read about online, and it was my only stock. It paid a dividend every quarter, so I never cared what the price was or even thought about selling it. The stock eventually paid 100% of its purchase price through dividends, and I sold it for a little more than what I bought it. 6. Understanding the nature of price fluctuations. Great investor Peter Lynch once said,
If you're one of those people that pore over graphs, economic statistics, or astrology charts, trying to figure out what the stock market is going to do next, you are wasting your time. No one can predict the market. You have to understand the market goes down. There's been 95 years this century. We've had 50 declines of over 10%. Of those 50 declines, 15 have been 25% or more. So about once every 2 years, the market falls 10%. About once every 6 years, it falls 25%. These are big drops. You have to understand that. That's the nature of the market.
Charlie Munger once stated that he's watched his holdings decrease by 50% or more at least 4 times in his career. A long-term investor must be able to suffer through a year or two of low earnings and low stock prices without selling. Warren Buffett's mentor, Benjamin Graham, has the following to say about price fluctuations. The true investor scarcely ever is forced to sell his shares, and at all other times he's free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book and no more. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment. In summary, these great investors are teaching us that when prices decrease, the value proposition of buying increases. The reason why understanding the intrinsic value of a stock is so essential is because the stock price may decline, but the value proposition of buying would go up, not down. A price decline on a quality company is not a risk. It's a sale on stocks. 7. Modeling future price drops. Since you understand the nature of price fluctuation, the next step is to build them into your investing strategy. Before buying a stock, ask yourself, what would you do if the stock declines by the following amounts in the next year? A 10% correction? A 20% crash? Or a devastating 40% drop? If this makes you uncomfortable, you may be setting yourself up for failure. You must be confident in the long-term viability of the company to handle these price fluctuations. Do both your modeling and homework before you are in a stock and deep in the red. Going through this exercise may help you leave a little bit of capital to the side to buy more shares in the event of a 20% drop, or forces you to do more research. 8. Worst case scenario. When things get awful, buy stocks, don't hold cash. In 2008, I worried about buying into the market because people were promoting gold and the collapse of the dollar, They had me thinking the dollar was going to collapse. But after the fact, I realized that 1, stocks hold value and are more valuable than currency. 2, if the dollar collapses, cash is worthless anyway. By being young, inexperienced, and buying into the fear, I missed the best buying opportunity of my lifetime. Don't miss opportunities because of fear. Summary. In summary, you should work through this mental exercise before making an investment in stocks. Having a long-term investment horizon, you're confident that in 10 years from now, the company's earnings will be higher. Due diligence. You've done your due diligence and believe the company will be doing well far into the future. Diversification and inverse correlations. You have enough assets in your portfolio that this investment won't kill you if it goes to zero. Correctly sized investments. You have correctly allocated the proper percentage of your portfolio towards this investment. If this investment goes to zero, it won't devastate you. Dividend. The company has a growing dividend and you would be happy with its yield if it had zero appreciation relative to government bonds. Understanding the nature of price fluctuations. You understand the nature of the market and that the investment can and will probably drop by 20 to 50%. Modeling future price drops. You have modeled what you would do in the event of various price declines. Worst case scenario. You conquered fear and can capitalize when others are fearful. When you combine all these thoughts together, you should be a more confident and prepared investor.